The Federal Reserve is off the script. To Jerome Powell, we need jobs, please. We need jobs. Hey everyone, it's Wolfgang. So there are more signs now that the Federal Reserve's monetary policy is too tight. I'm going to explain what monetary policy is. So there's more signs that the Federal Reserve is keeping interest rates too high for too long. This is the same thing they did in reverse back in 2022 when inflation got up as high as 9%. I think it was 9.1% in 2022, which is astonishingly high. The Federal Reserve waited and waited and waited too long to raise interest rates to lower inflation. So right now they're doing the exact opposite. They're keeping interest rates too high for too long. Okay, so what I'm going to do is explain how lowering interest rates will create more jobs for everyone in the U.S. But first, I want to talk about what monetary policy is. It's very simple. Monetary policy is the Federal Reserve, also called the Fed, making a choice, one of three choices: raising interest rates, lowering interest rates, keeping interest rates unchanged. Interest rates determine how much it costs to borrow to buy a car or a house, credit card to use credit cards. Interest rates control how much people will buy. If interest rates are very low, more people will buy more stuff. If interest rates are too high, fewer people will buy less stuff. Fewer cars, fewer homes. They won't use credit cards as much. Interest rates are the way to control consumption in the economy. Consumption means buying stuff. Consumption means companies are selling stuff, right? So monetary policy is the Fed, the Federal Reserve, making a choice between raising interest rates, lowering interest rates, or keeping interest rates unchanged. And that controls how willing people are to buy stuff. 70% of the United States economy is based on people buying stuff, right? It's called consumer consumption. So the interest rates control the consumption, and the consumption controls how well the economy is doing, which determines how hard it is to get a job. Because when more people are buying more things, companies are selling more and they need to hire more. So how does the Fed choose one of these three things? Raise, lower, or keep the same interest rates? The Fed looks at inflation. The Fed looks at the job market, and then they choose 1, 2, or 3. They look at the current rate of inflation. Is it high or is it low? And what's the job market like? Is the job market good? Is it bad? Then they choose 1, 2, or 3. Okay, so that's the background. That's monetary policy. So let's just assume for now that the Fed looks at the job market and notices the job market is falling. It's getting bad. It's poor. And they also notice inflation is low. If the Fed notices the job market's poor and inflation's low, what should they do? If people are having a problem getting a job and there's very little inflation, it means people are not buying enough stuff in the economy. That means interest rates are too high, because if you lower interest rates, more people will buy more stuff. Okay? So what is low? What does it mean to have low inflation? Right around 2%. And what does it mean to have a job market that is poor? It's hard to get a job. Not enough jobs are being created. In that case, if the job market is poor and inflation's low, choice 2 makes sense. If you lower interest rates, more people will buy more stuff. Companies will sell more stuff. Companies will have to hire. That will fix the job market. And it will not instantly raise inflation. Inflation is very slow moving. Inflation is like an ocean liner, very slow to change. So right now, as it turns out, the job market is poor. And I will give evidence for that in a couple seconds here. And inflation is low. So the Fed should be doing choice 2. They should lower interest rates, and they're not. There have been signs for a long time that the job market sucks. There have been signs for a while that inflation is low. Remember, in 2022, inflation was over 9%. So what is inflation now? Inflation is about 2.3%. It was 9.1% in June 2022, about 3 years ago. Inflation got, it was almost 4 times higher than it is now. It was 9.1% 3 years ago. Now it's fallen back to its almost normal 2%. It's expected that on June 11th, when they announce the inflation number, the government will announce that inflation has fallen to 2.1%. Inflation's low, the job market sucks. They should be lowering interest rates. So what is the unemployment? It's the worst in 2 years. The unemployment scene is the worst in 2 years and 2 months. It has not been this bad since March of 2023. March of 2023 was a match for the lowest number of new jobs that have been created. Right now, ADP, which is a payroll processing company, a huge one in the United States, the ADP announced that private sector jobs were 37,000 last month, okay? 37,000 for the entire country, new jobs created, only 37,000. So how many people are in the United States? Over 350 million, right? Not all of them are working, but well over 100 million of those people are working, and only 37,000 new jobs were created last month. The month before, 60,000 jobs had been created. So it went from 60,000 jobs, it dropped to 37,000 jobs. Worst job creation numbers in two years and 2 months. It hasn't been this bad since March 2023. That's a big drop from April, as I said. So the job market is trending down. It's getting worse. And the economy is therefore in a slowdown. So that means the bolts are too tight. Interest rates are too high. People are not buying enough stuff. Companies are not selling enough stuff. Companies are not hiring enough people. So we're in the job market's getting worse, and the economy is slowing down in the U.S. And so the Fed, Jerome Powell, is off script. They have lost reality or something. It's hard to understand why they're doing this. We need jobs. We need more than 37,000 new jobs. The ability to earn an income means you can feed yourself, feed your family, and avoid the chaos that comes from being broke or destitute. Anyone who wants to work should be able to work. And right now, that's not happening. So a quick explanation of how lowering interest rates will help. Okay, the choice 2, lower interest rates. That's what we need the Fed to do. They need to lower interest rates. It will stimulate the economy. How? How does lowering interest rates create new jobs? If interest rates are lower, loan for a car is cheaper. More people can qualify to buy a car, can buy a house because interest rates are lower for the home loan. Credit card interest is lower, so people are more likely to use their credit cards to buy stuff. People are buying more cars, more homes, and more stuff with their credit cards. They're taking out more loans for cars, more loans for homes, and they're using their credit cards more. People are buying more, companies are selling more, companies are hiring more. That will fix the unemployment problem. So that's how lowering interest rates will help. Right now, interest rates are too high, basically. So there's a couple things I could not fit on the board. So just a quick review, though. So interest rates should fall to 2.1% when they're announced in a few days, about 6 days, on June 11th. Right now, interest rates are almost at the desired 2%. They're at 2.3%, trending down. And the job market is in poor shape, right? So it's time for Jerome Powell to lower interest rates. So how do we know that will help? Okay, how do we know lowering interest rates will help? Do we have any actual proof? Because this has kind of all been theory. The idea that, okay, we lower interest rates, people will buy more stuff, companies will sell more stuff, companies will hire more. Do we know that's true? Yes. In the 2008-2009 financial crisis, what did the Fed do? They lowered interest rates to almost zero. If you look up zero interest rate policy online, ZIRP, you will find that the Fed, after the 2008 and 9 crash, the Fed lowered interest rates to near zero and kept them very low for a long time. And the economy recovered. It took a while, but the housing market was in horrible shape in 2008 and 2009. People were abandoning their homes, giving the keys back to the bank because they didn't want to make the payments because the value of homes had dropped so much that the loan was too high for what the home was worth, and so people just walked away. You could not give away homes back then. That changed. They lowered interest rates. Loans for cars, houses, and using credit cards dropped. When they lowered interest rates, people started buying more cars, more homes, and more stuff with their credit card. It does work. We know for a fact it works. So that was the most recent proof we had that the Fed can fix this if they want to, but they have to want to. And the question is, does Jerome Powell want to? Maybe not. I don't know. Maybe he knows, right? But this is the middle of 2025. He is going to be out of that job in about a year. So maybe he doesn't care so much about doing the best job he can, because the best job he can right now would be to avoid the mistake they made back in 2022 when they waited too long to make the right choice here. Because when it comes down to it, monetary policy is making the right choice, 1, 2, or 3, at the right time. The timing is critical, because if you wait too long to raise interest rates like he did in 2022, inflation got all the way up to 9.1%. It just took off because interest rates were too low for too long. So the timing, it's sort of like if you're a musician and your timing is poor, you should keep music as a hobby, because you're not going to be able to make good recordings. You have to have good timing. The same with comedy, the same in professional sports. If you're a professional, or you claim to be a professional, but your timing is bad, you're not a freaking professional. You've got to have good timing. Right now, this guy's timing, he has a history of poor timing. That's the proof is inflation should never have gotten that high. We all know what that was like when inflation was skyrocketing and the price of everything was going up. He shouldn't have waited as long as he did to raise interest rates. Interest rates were zero for a long time to recover from the 2008-9 crash. He kept them that low for too long. He waited too long. And then if you remember, starting in October 22, there were huge increases in interest rates. All of a sudden, he realized his timing was bad. His timing is off now too. So he needs to fix this, because the primary thing is, it's not a Jerome Powell thing. It's everyone in the U.S. who wants a job should be able to find work so they can feed themselves and feed their families. This is about people being able to take care of themselves, so we have stability in our social lives and in the economy. So some people learn from their mistakes. If your timing is off in something you're trying to do, generally, you'll notice that, or people will tell you that your timing is a little bit off, and you will make corrections. You'll try to do better the next time. And for some reason, this guy is not correcting that error. So I don't get it. But right now, the job market is the worst in 2 years. 2 years and 2 months, to be exact. The number of new jobs has not been this low, this bad, since March of 2023. So he is blowing it, and I'm disappointed, because if you listen to him, he doesn't sound like a stupid person at all. He sounds like he understands things, but for some reason he's repeating the timing problem. He has poor timing, and I don't get it. So anyways, if you have any questions about this, please post questions in the comments, and I'll try to answer your questions. And this is not a knock personally on Jerome Powell. This is a knock on the choice of waiting too long to lower interest rates. He should have lowered interest rates already, because there have been signs the job market has sucked for a while. And so that's where things are. If you have any questions, please post in the comments. I'll try to answer them. And I really want to thank everyone for watching, and have a great day.